Start, madam.
Good morning, dear students. Welcome to Commerce class. First, I thank to TREI Society to give me a wonderful opportunity to teach you all. Okay, in last class we have discussed about straight line method. What is the straight line method? Straight line method is the rate of depreciation is the same for every year. Okay, the depreciation will be calculated on the original cost of the asset. For every year, the amount of depreciation will be the same. Okay, we as per the Board of Intermediate, we have two methods to calculate the depreciation. One is straight line method, and other one is diminishing balance method. Okay, today we are going to discuss about diminishing balance method. Under this method, depreciation is calculated at a fixed percentage on the diminishing value of the asset. Okay, depreciation will be calculated on the diminishing value. Every year, the cost minus depreciation, the remaining amount is the written down value. On that written down value, we will calculate the depreciation. Okay, depreciation is provided at a fixed percentage on the cost of asset in the first year. In the first year, the cost of percentage is same. Okay, the depreciation will be calculated on the cost of the asset. But in the second year, the amount of depreciation will be changed. On written down value, we will calculate the depreciation in the subsequent years. This method is also known as written down value method or reducing balance method. Okay, since the depreciation is calculated on the balance of the asset after writing off depreciation on the asset, it is named as written down value. For the first year, we will calculate the depreciation on the original value of the asset. From next year onwards, we will calculate the depreciation on the written down value. For every year, the amount of depreciation will be changed, but rate of the depreciation will be the same. As the depreciation is calculated on the reduced balance of the asset brought down from the previous year, it is called reducing balance method. For first year, we will calculate on the original cost, but on the from next year onwards, we will calculate the depreciation on the written down value of the asset. Okay, the balance will be reduced every year. The balance will be reduced. On reduced amount only, we will calculate the depreciation. So it is called as written down value or reducing balance method. Okay, this is also two names. First is the diminishing balance method. Okay, or reducing balance method. In this method, the rate of depreciation remains constant, whereas the amount of depreciation decreases year after year. The amount of depreciation will be decreased year after year because we will calculate on the written down value. In straight line method, we used to calculate on the original cost of the asset. So the amount of depreciation every year it is same. But in a diminishing balance method, the amount of depreciation also decreases year by year. Okay. For example, a machine purchased for 20,000, depreciation rate is 10%. Okay, calculation of depreciation. Here one question is that a machine purchased for 20,000. Okay, 20,000, one machine was purchased. They have given rate of depreciation also. Rate of depreciation is 10%. Calculation of depreciation. Okay, in the first year, cost into rate by 100. Cost means here 20,000. 20,000 into rate. Rate means 20,000. Okay, here rate means 20,000. Okay, 20,000 is a depreciation value. Okay, cost is the 20,000 into rate 10%. Okay, 20,000 into 10 by 100, it is 2,000. For the first year, depreciation amount is 2,000, and written down value at the end of the first year is cost minus annual depreciation. For first year, the amount of depreciation on cost only we will calculate, but on next year onwards, we will minus the depreciation, deduct the depreciation from the cost of the asset. Okay, cost minus annual depreciation. Cost is here 20,000 minus the first year amount of depreciation is 2,000. It is 18,000. Now written down value of the asset for the next year is 18,000. In the second year, depreciation is equal to written down value into rate by 100. For the first year, cost into rate by 100. Second year onwards, written down value into rate by 100. Written down value here 18,000 into 10 by 100 is equal to 1800. Written down value at the end of the second year is equal to 18,000 minus 1800 is equal to 16,200. Okay, for every year the amount of here you can observe that the amount of depreciation also decreases. First year it is 2,000, second year 1,800, and third year here the amount of depreciation will change. Okay, in the example, it is understood that the amount of depreciation is reducing year after year. That is first year 2,000 and second year 1,800, third year 1,620. Like that, for every year, the amount of depreciation will be changed. Okay. Here, the amount of depreciation as given and the rate of depreciation also they have given. But sometimes they ask to find out the rate also. Rate of the depreciation under written down value method, the one formula is there. Rate of depreciation is equal to 1 minus n by under root of s by c into 100. Here R means rate of depreciation. Okay, n means number of years. Number of years here in the sense estimated life of the asset. S is scrap value and C is the cost of the asset into 100. Into 100, why? Because we are using here into 100 means rate. Here we have to find out the rate. So we have to multiply with 100. The original cost of the asset is 9 lakhs and its scrap value is 50,000. Expected working life is 16 years. Then the rate of depreciation is calculated as, okay, one example is there. The original cost of the asset is 9 lakhs and scrap value is 50,000. Expected life also they have given 16 years. Okay, 16 years. We can substitute in the formula 1 minus, here 16 is the n. N means estimated life of the asset. Okay, 16 under root of 50,000. Here 50,000 is the scrap value divided by cost. That is 9 lakhs into rate into 100. Okay, into 100 we will get by substituting the values in the formula we will get 16.6%. The rate of depreciation under written down value is here in 16.6%. Okay, this method is suitable for those assets in relation to which the amount of repairs goes on increasing as the asset grows older. The possibilities of obsolescence are more. Okay, the asset became year by year older. No, the obsolescence also more. Okay, obsolescence means outdated. Asset is outdated because of technology, new technology, the asset will be outdated. It is suitable to plant and machinery, furniture, buildings, etc. Okay, this method, written down value method, is suitable to plant and machinery, furniture, buildings. Okay, these are the fixed assets. Okay, advantages of diminishing balance method. Okay, the important advantages of diminishing balance are as follows. Uniform effect on the profit and loss account. The total charge, that is depreciation plus repairs and renewals, remains almost uniform year by year, year after year. Okay. Since in early years, the amount of depreciation is more and the amount of repairs and renewals is less. Whereas in later years, the amount of depreciation is less and amount of repairs and renewals is more. Okay, under this written down value method, the effect will be the depreciation amount will be decreases and the repairs value will be increases year by year. Okay, we will consider as a total charge, how much per year, depreciation plus repairs and renewals, almost uniform year after year. Okay, in this method, the we will calculate on the written down value. So in the subsequent years, the amount will be uniform. Okay, logical method. Okay, it is a logical method. It matches the service of the asset with the depreciation charge. When asset is more efficient in the initial years, higher depreciation is charged compared to later years. Okay, it matches the service of the asset with the depreciation charge. First 1 to 3 years, the asset efficiency is more. Later years, it will decrease the asset. Okay, asset efficiency of the asset. When asset is more efficient in the initial years, higher depreciation is charged compared to later years. First the 1 to 3 years, the asset efficiency will be more. The rate of the amount of depreciation also more. Coming later years, the amount of depreciation will be decreased. Logical method. It matches the service of the asset with the depreciation charge. When asset is more efficient in the initial years, higher depreciation is charged compared to later years. First 1 to 3 years, for the asset efficiency of the asset will be more. So depreciation also more. Later years, the efficiency will be decreased and amount of depreciation also decreased. Risk of obsolescence. It recognizes that risk of obsolescence by charging the major part of depreciation in the early years of the life of the asset. Okay, risk of obsolescence. Obsolescence means outdated. Okay, through modern technology, the asset will be the old asset will be outdated. Tax deferral. It results in a better cash flow through tax deferral under this method. The new income to be taxed is lower in the initial years and higher in subsequent years. As and when additions are made to the asset, fresh calculations of depreciation are not necessary. Okay, the tax deferral. It results in a better cash flow through tax deferral. As under this method, we will calculate the depreciation on the written down value only. Income to be taxed is lower the initial years, higher in subsequent years. Okay, lower the tax benefits also we will get. As and when additions are made to the asset, fresh calculation of depreciation are not necessary. Okay, these tax benefits also will get through charging the depreciation. Suitability. This method is most suitable to those assets that have more efficiency in the beginning and later on decreases year after year. This is the assets, for example, plant and machinery, furniture, buildings. First starting years, they will be more efficient, but later years the efficiency of the assets will be decreased. This method is suitable for those assets. This method is adopted for plant and machinery, furniture and fittings, motor vehicles, etc. The method is accepted by income tax authorities under the Income Tax Act 1961. Okay, this is the accepted by the income tax authorities as per the Income Tax Act 1961. Okay, these are the advantages of the diminishing balance method. Okay, we can see the advantages of the now we can see the disadvantages of the diminishing balance method. Major drawbacks of major drawbacks or disadvantages of diminishing balance or reducing balance method are as follows. Okay, not suitable for all assets. These are suitable for only plant and machinery, furniture and buildings. Okay, this method is not suitable for all the assets. The method of depreciation is not suitable or not applicable for the assets having less value and short life. It is suitable only for valuable assets having long life. Okay, this is the method useful for the assets which have long life. Okay, for example, plant and machinery, the life of the asset will be more. Buildings also, the life of the buildings also more. This method is suitable for those assets. Loss of interest. In the method of depreciation, deducted depreciation amount of previous year is not invested outside. Okay, the amount of depreciation we providing for every year, the depreciation, that amount will be remained in the remained as working capital only. We will not invest that amount outside, so the returns will be less. The company does not earn any interest on or revenue from it. Okay, it is part of the working capital only, so the returns will be less. Okay, higher rate. Diminishing balance method requires higher depreciation rate to recover the cost of assets. Diminishing balance method requires higher depreciation rate to recover the cost of assets. Okay, it will require higher rates. Then only the value of asset will be replaced in the place of old asset. Okay, book value. In diminishing balance method, value of asset cannot be written off. The book value of asset never becomes zero. Okay, the asset value will be remains same. So the total asset value will not be written off. It will never becomes zero. Difficulty in calculation. Under this method, there is no uniformity in depreciation amount. It is difficult to obtain the exact rate of depreciation. Okay, it is every year the amount of depreciation will be changed. So the rate of depreciation also difficult to calculate. Okay, for every year we have to calculate, means that the difficulty will be more to calculate the rate of depreciation for every year. Okay, the difference now, the difference between straight line, we have learned in last class straight line method, and in this class we have discussed about written down value method. Okay, what are the difference between these two means we can observe in the following. Okay, meaning a method of depreciation in which the cost of asset is spread uniformly over the life years by writing off a fixed amount every year. In straight line method, the amount of depreciation for every year, it will be the same. A fixed amount of depreciation we will charge for every year throughout the estimated life of the asset. In diminishing balance method, depreciation in which a fixed rate of depreciation is charged on the book value of the asset over its useful life. Book value means after deducting the depreciation from the cost. First year will be, we will calculate on the cost, and next year onwards we will calculate and written down value. That is cost minus depreciation. Okay, that the amount of depreciation will be changed for every year. It will be decreases throughout the life of the asset. Okay, second point, calculation of depreciation. Okay, calculation of depreciation on the original cost of the asset. We will calculate on the straight line method. We will calculate the depreciation on original cost of the asset. In diminishing balance method, on the written down value of the asset. Okay, cost minus depreciation. For second year onwards, we will calculate the written down value. And first year, we will calculate on the cost. Okay, annual depreciation charge. In straight line method, it remains fixed during the useful life of the asset. Okay, the annual depreciation will be same throughout the life of the asset. But in written down value, the amount of depreciation will be reduces every year. Okay, value of asset. In straight line method, the value of the asset completely written off after the estimated life of the asset. In written down value, not completely written off. Okay, not completely written off. It means the asset value will not become the zero at the end of the estimated life. Okay, amount of depreciation. Okay, the amount of depreciation in straight line method will be only one amount we will charge for every year. It will be lower. But in a written down value method, initially higher the amount of depreciation compared to straight line method. Okay, impact on profit and loss account. Okay, increasing trend. In straight line method, the impact will be more in increasing value in the straight line method. In diminishing balance method, it will remains constant. The impact of depreciation on the profit and loss account, the depreciation will be constant. Remains constant. Okay, preference. Assets with negligible repairs and maintenance like leases, copyright, etc. Okay, this method is preferred by assets with negligible repairs, small repairs and maintenance like leases, copyrights, etc. This method is useful for this assets. Okay, assets in written down value method, assets whose repairs increases as they get older, like machinery, motor vehicles, etc. This is useful for the plant and machinery. It will became older as years passes. So the motor vehicles efficiency of motor vehicles also decreases as day by day. Okay. Recognition. It is not recognized by the income tax department. Straight line method is not recognized by income tax department. The diminishing balance method is recognized by the income tax department. Okay. Next, balance of the asset account. The value of the asset can be reduced to zero or scrap value. In straight line method, the asset value may become to zero. Okay, the value of asset cannot be reduced to zero. Okay, in written down value, the asset value cannot be reduced to 0. Okay, one example is there. On 1st April 2017, Santosh Brothers purchased. Okay, Santosh Brothers purchased furniture for 40,000. Installation charges paid by them 10,000. Here they have given cost of the asset. It is 40,000, and installation, while installing the asset, some charges will be there. It is known as installation charges 10,000. Depreciation is provided at 20% under diminishing balance method. Okay, under diminishing balance method, the rate of depreciation is 20%. They have mentioned to calculate the depreciation under the diminishing balance method. Okay, first we have to pass journal entries and prepare. We can easily prepare furniture account. Okay, for the first 3 years, we have to provide depreciation. We have to prepare the machine account. Okay. Okay. In first entry, we have furniture account data to bank account. Okay. Furniture account data to bank account. First, the asset purchased by the Santosh Brothers. The entry will be furniture account to bank account, being the narration is being the furniture purchased. Okay, furniture is the asset. Asset is coming into the business. Okay, as per real account, debit what comes in and credit what goes out. Okay, the amount of cash is going out of the business. So to bank account will be credited. The asset will be coming into the business. Furniture is account is debited. Okay, next entry, furniture account data to bank account. Okay, 10,000. For installation charges also, we have to journal entry is furniture account only, because it is the installation charge. We can provide installation charge at the time of installing the asset. So we have to mention furniture account only for installation charges also. Furniture account data to bank account. Cash is going out of the business. So as per the real account, debit what comes in. Okay, furniture account debit all the expenses. Okay, installation charges will be debited. Okay, depreciation account data to furniture account. The next entry is the for providing the depreciation 20%. Okay, depreciation account data to furniture account. Okay, all as per nominal account, all expenses and losses should be debited. So depreciation is the expenditure. Okay, depreciation is debited. Depreciation account will be debited. Okay, next, profit and loss account data to depreciation account. As profit and loss account, we will transfer the depreciation amount to the profit and loss account. In first year, we have prepared final accounts. In that, depreciation will be debited in the profit and loss account. Okay, profit and loss account, the expenses will be debited. We have to transfer the amount of depreciation to the profit and loss account. Okay, next entry, depreciation account data to furniture account, being depreciation provided. Okay, profit and loss account data to depreciation account, it is to transfer the profit and loss account, the depreciation amount. Okay. One small working notes will be there. Cost of the furniture, the installation charges will be added to the cost of the asset. It will become complete cost of the asset. Okay, after adding the installation charges, it is cost of the furniture is now 50,000 because installation charges is while installing the asset, the expenses will be incurred. That is installation charge. So cost of the asset now 50,000. Okay, depreciation on 31st March 2011. They asked you to prepare machine account for 3 years. Okay, first year is the March 2011 December. Okay, March 31st 2011. The financial year is April to March. Okay, 50,000 cost of the asset. Now what is the amount of asset? 50,000. 50,000 into rate of depreciation is 20%. It is 10,000. Okay, it is a written down value method. And first year we will provide the depreciation and the cost of the asset, and next year onwards we will deduct the depreciation amount year by year from the written down value. Okay, depreciation on 31st March 2012. Okay, second year. This is the second year. What is the written down value? Here 50,000 minus the rate of the amount of depreciation is 10,000. Okay, it is 40,000. 40,000 into rate. Rate means 20 by 100. It is 8,000. And next year, third year, depreciation 31st March 2013. Okay, the written down value will be 40,000 minus 8,000. It is 32,000. Written down value will be for the third year 32,000 into rate 20 by 100. It is 6,400. We can observe that amount of depreciation year by year it is decreasing. Okay, first year 10,000, next 8,000, next 6,400. So it is called as written down value method or reducing balance method. Okay, next we have to furniture account. Okay, furniture account. Okay, furniture account, we have to prepare furniture account. Okay, at the end of the financial year. Okay, furniture account. Okay, 1st April 2017. Okay, to bank account. Here, to bank account. Okay, to bank account 40,000. The cost of the asset is 40 plus 10,000. 10,000 is the installation charges. Okay, to bank, furniture account data to bank. Okay, now we have to provide depreciation here 10,000. Okay, first year we already calculated depreciation for the first year is 10,000. 10,000 we will balance the amount. 40,000 is the balance carried down. This balance carried down will be carried forward to next year. That means 1st April 2018. Okay, to balance brought down. It is 40,000. The balance carried down will be the next year opening balance. Okay, 40,000. 40,000 at the end of the year 2000. Here 1st April to March 31 is the financial year. Okay, 2018 1st April is the starting second year, and at the end of the year 31st March 2019 we have to provide the depreciation. It is depreciation account by balance carried down. Okay, okay, by balance carried down is the 32,000. This amount will be carried forward to the next year. That is 1st April 2019 to balance brought down 32,000. Okay. 31st March 2020 by depreciation account. Here we already calculated for third year it is 6,400 depreciation as per written down value method. Okay. The balance will be 25,600. It will be carried forward to next year. Okay. This asset will be carried forward to next year. Okay. Amount of this balance amount of the asset. Okay. Here they mentioned to prepare for 3 years only. So we are preparing for the 3 years only. This is the asset value will be remained in the business. It is 25,600. Okay. If you working in the company, you have to provide the depreciation as long as the life of the asset. But here, as point of view in here, it is we have to prepare for 3 years only. Okay, we have prepared machine account for the machine means furniture account for the 3 years. That is 1st April 2017 to March 31st 2018 first year, and 1st April 2018 to March 31st 2019 is the second year, and 1st April 2019 to 31st March 2020 third year. Okay, we have prepared machine account for 3 years. Okay, one example. We will see one example. Okay, Jagadish and company purchased a machine on 1st July 2017 for 28,000. Okay, he had spent 1,000 for carriage and 1,01,000 for installation. Okay, carriage means this is a transport charges. Okay, for asset only. Okay, for asset installing the asset, these are the expenses he incurred. The machine is depreciated by 15% every year, and written down value prepare machine account up to 31st March 2020. Okay, here he has mentioned to prepare for 3 years. 3 years machine account. Okay, here we have to prepare for the 3 years. Here machine account. Okay. Here machine account. Okay. Okay, machine account. Okay, machine account. Credit, debit. This is the account. So we have to mention debit side and credit side. Okay. We will make columns. Okay. Here we have to mention date, particulars, amount, date, particulars, amount. Okay, 4 columns. 1, 2, 3, 4, 5, 6 columns. Okay, like this. This is the machine account. To bank. Okay, like this. This is the pro forma. We have to prepare machine account. Okay. This is the pro forma of machine account. We have to prepare. Okay, first for the first year, to bank account it is 28,000, and carriage is there, no carriage 1,000, and 1,000 is the installation charges. So to bank account 28,000, and installation and carriage it will become 2,000. So the cost of the asset will be 30,000. Okay, like this. Depreciation we have to provide. Okay, depreciation per asset is purchased, the date we have to see the date. Okay, July 2000.
Madam, conclude, madam.
Sir,
conclude.
Okay, this is the pro forma of machine account. So this is the assignment for you. This is the question. Okay, we have to prepare machine account for the 3 years. Okay, today we have discussed about diminishing balance method. Okay, under this method we have prepared machine account for 3 years. Okay, the rate of depreciation is the same, but amount of depreciation will be different. For every year it will be decreased. Okay, in this you can do the sum as machine account for 3 years. Okay, for the first year the cost will be 30,000, and then on 30,000 we have to provide depreciation. This is July 2017 they have purchased a machine. Okay, July 2007 we have to calculate the months from July. Okay, July, August, September, October, November, December, like this 9 months. For 9 months we have to provide depreciation for the first year. For 9 months it is rate of depreciation is 15%, and second year on written down value we have to provide depreciation, and that cost minus annual depreciation, that is the written down value of the asset of second year. Okay, like that for 3 years we have to prepare machine account. Okay, for third year also the cost of asset will be the remaining balance of the asset minus the depreciation. It will give the written down value of the asset third year. Okay, we have to provide the rate of depreciation is 15%. The amount of depreciation will be changed for every year. It will change. Okay, this is the assignment for you. Okay, thank you for giving this opportunity.